Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Well, the pictures made it absolutely clear, and I think the visuals here, all three of us in blue, I think, as they say, picture tells 1,000 words and, the whole story, and I think it's absolutely undeniable how all of us feel today. It's Team India, women's cricket, and a big, big win last evening. This is Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Surabhi and Nigel. Guys, morning.
Ooh, morning. We all, I think, slept too few hours, but that is not a problem at all, is it? Because the women in blue are on top. They're shining. A lot of people are equating this to the 1983 World Cup moment for women's sport here in India. And I can tell you guys, is this, never a feminist, like I say, but this one is more about the game. It's more about the win. It's more about a World Cup. It's a huge moment for women and girls in this country.
Well, just
happy.
Just take a look at the celebration up there. And the coach himself, Amol Majumdar, one of the best domestic players, coaching the side to that victory. The girls in blue made us so proud yesterday. Goosebumps as we started the show itself. It's just been a few hours since they're world champions. And just take a look at those visuals. Absolutely fantastic visuals. The girls in blue, you'll have done us proud. And I tell you what, from here on, Indian women's cricket will just go from strength to strength. What a moment, guys. What a moment.
Absolutely. And obviously, the congratulations are pouring in across lines. A lot of, cricketers, members of the India 11 men's squad, they've been celebrating. But I thought Sachin Tendulkar's tweet really summed up that emotion. And he was also among those who, kind of equated this to the 1983 World Cup moment, talking about why. Okay, great. We have that quote up. 1983 inspired an entire generation to dream big and chase those dreams. Today, our women's cricket team has done something truly special, inspiring countless young girls across the country to pick up bat and ball, take the field and believe that they too can lift that trophy one day. It's inspiration beyond what can be captured.
Absolutely. And I think, each of these girls, right? I mean, I've not followed women's cricket that closely, but each of these girls, I was reading the Indian Express, and by the way, the newspapers are full of stories about, the backstories about each of these women.
Yeah.
Shefali says,
what a cracker.
who cut her hair short just to sneak into boys' games, right? Deepti from Agra, and who, of course, who traveled 12 kilometers a day to train, who's got now a street named after her in the city of Taj. Amanjot, who wasn't allowed to play by boys in her neighborhood. And so it goes. These are,
And, they tell you, for women to go out there, and we always talk about glass ceilings, etc., but to go out there in a game that's predominantly been a boys' game, a game of endurance, to convince your families to back you, to convince, that whole conversation about, okay, what happens when you get married and all, to go past all that, to go past how you look, and go out there and conquer. It's a huge...
And there were a couple of games in this tournament itself and you would have ruled them out. They would have said the tournament is done for them. But they came back, the girls in blue, and they fought on. And just one point with regard to this entire 1983 buzz. Yes, it's the 1983 moment, but I'll tell you what. We won't have to wait that long because people like me who were born after 1983, we didn't see a World Cup win for many years.
Yeah.
So I'll tell you what. the girls in blue, we won't have to wait so long, going by the performance, going by the momentum. 1983 moment, yes, but we won't have to wait so long to lift the trophy
and that's
yet again.
what Harmanpreet said, right? That this is not just a culmination. Yes, it is a win for all the senior players, all the women players who've been leading up to the moment.
I was reading this article to my son in the morning, and I said, the article goes on about how they were ignored and, basically not as much limelight, infrastructure, facilities that the boys cricket got. Well, he looked at me and said, well, isn't it a little ironical for the newspaper to say all these things and in the first place not cover them? Why, all this while. So,
I think a lot of that is going to change. A lot of that is going to change forever and for the better.
Yeah. I think we'll, of course, continue to get you pictures, and it's a seminal moment in that sense, and I don't use that word lightly. Let's just now turn our attention back to markets, financial markets, and where we stand before we go any further. So, as always, I think we'll pick it up from Friday's session. Which is, of course, a better day. Thursday was bad, remember, and there were some murmurs that maybe the market in the US is also starting to see the first signs of correction. It's going to roll over, etc., etc. Actually, Thursday's session was the worst it had since June, on the back of some numbers, etc., no doubt. But then Friday, equities in the US came back up. Nothing very large, but about 0.25%, 0.3% in that sense. Now, China, in new sort of news, post-market hour news, China is going to suspend some curbs on rare earth exports, and also it's going to sort of suspend some US chip firm probes. So it's de-escalation, what was agreed upon. No progress on the government shutdown in the US. It's entered its 6th week. And I think, I was reading that if this shutdown goes past the 5th of this month, it's going to be the longest shutdown ever. So there you go. There you have it, which means that no data, right? Data releases continue to be impacted. The ADP is the private payrolls number, is the main data release that we will get on Wednesday. By the way, Wednesday is also market holiday here in India, but that's, of course, so it's a midweek break. Now, the US 10-year yield hit 4.115, so it spiked to about that level, and it ended at about 4.07 or so. So it kind of completely cooled off. Treasuries rallied by the end of it. Over the weekend, OPEC Plus has agreed to boost oil production next month, but by a much smaller amount, so 137,000 barrels per day. It's not moving oil prices at all. But it's also saying that it will pause further output hikes in the first quarter of 2026 to avoid a glut in oil prices. So a glut in oil and then oil prices as well. Gold, there is some news, but it's kind of sort of, tangential. China is scrapping a long-standing tax break on gold, which basically made gold very affordable for China. Chinese consumers and Chinese retail consumers are some of the biggest buyers of gold in the world. There are reports which say, just staying with global but also local for one bit more, that India is planning to almost triple its incentives for rare earth magnet manufacturing to over 7,000 odd crore rupees. So, and this is something that we've heard from investors here as well. Look for some of these themes where the government is a big supporter and you've got that tailwind behind you. Big earnings, actually through the course of the week, you got some large numbers. Today, Bharti, Titan, Tata Consumer, Mahindra & Mahindra, among others, which will report. And now I come to levels then. So, Nifty saw some follow-up selling on Friday. For the week, though, the market was kind of flat. We ended on the Nifty below the 40-hourly exponential moving average. It was a negative weekly close. Small, but it was a negative weekly close. The one sector which really stood out over the 5 trading sessions was the PSU bank space. The index itself was up 5%, and I suspect lots of technical analysts will look for trades in that bucket more than anywhere else. There is momentum and there is volumes there as well. I'll just list out the supports. The resistance levels are the recent highs, so I'm not going to go there. 25,700 for the Nifty is basically the lower end of the range, and 25,526 is where the 20-day moving average comes in. 25,350 or so is where the 40-day, but we'll take it step by step. Nifty Bank also closed on Friday below the 40-hourly exponential moving average. And here, the support is the swing low of 58,232 and then 57,340 is the next number. GIFT Nifty will give you a quick sense of how we're likely to start, and then we'll pick it up from there. 56 odd points lower is the start this morning. Nigel, over to you.
Well, I'll tell you what, that softest start will be encouraging for the Bulls' perspective. I'll tell you what, because last night we have this momentum that's coming in from the cricket game, and hopefully the Bulls as well can get some momentum going, which has been lacking in the last couple of trading sessions. Let's explain this to you. One problem pocket has been the FIs. They were sellers, they turned neutral, now they're selling for the last few trading sessions. You don't want that to weigh as well. So in the cash market flows, you don't want the FI selling to get too large. Well, moving to the FIs and index futures, they added some shorts. We were saying a few sessions ago that we were missing shorts in the system. They've granted your bill. They've gone ahead and added some short positioning. It remains at around 84%. And from the start of the series, you'll see that the FI net short positions has moved up by close to around 25,000 contracts or thereabouts, from less than a lakh contracts to around 1.2 lakh contracts. The clients on the flip side, well, they were net long with close to around 75,000 positions on the long side. They've added close to around 10,000 contracts in the last few trading sessions. So clients long, not very, very aggressively net long, while FIs, they are net short. Normally, this combination is quite good. And if they move to different directions, actually, history suggests that it's quite good. Even on stock futures, normally there's an arbitrage that takes place out there, but there were shorts that were added on stock futures as well. Moving to the options data, the FIs, well, they wrote calls aggressively. So close to around 3 calls were written for every one put in Friday's trading session. So the positioning itself seems to have turned a little bit bearish from the FIs, which is good actually, because you've seen those shorts can get caught out on the wrong side. And the PCR has moved to the lower end of the range. So that's one encouraging data point. Normally at around 0.6, 0.65, we do see a bit of a bounce. So that's why I'm saying the GIFT 50 suggesting a soft start actually could be music to the ears of the Bulls, because you're bracing for a bit of a pullback intraday itself. And the reason the PCR came down is because the call writers, they are making merry. Aggressive call writing is what we saw, though we have the 25,700 put as well that was fairly active. That brings us to the levels. Till this 20 DMA holds out, which is at around 25,500, you'll have to say that the Bulls believe there is some unfinished business at higher levels. So, you'll want that level to not get breached at 25,500, 25,700 going by the options data. You'll want this, the recent high as well. That'll be a bit of a resistance mark, which is at around 25,950. On the Nifty Bank, it's going to be quite crucial, and I'll tell you why. Because on a day-to-day basis, the Nifty Bank has been making lower lows. So you'll want this actually to break, this lower lows kind of trend. So the Nifty Bank will have to find its form. It's in a decent pullback from the recent high. So the Nifty is going to be starting off a little bit softish. Various technical indicators, whether there's a short positioning or the PCR indicates that maybe in today we do see a bit of a bounce. So let's see how it goes.
Okay, absolutely. By the way, across Asian screens, it's a bit of a mixed picture. Japan is today shut for a local holiday. The China market has just seen the release of the private sector PMI numbers, which are a little shy of expectations. There's also deceleration in October compared to September. But despite that, there are incremental gains, at least in the Hong Kong markets. Mainland China is a little soft, but Hong Kong, Taiwan holding up, as is Singapore. So not too bad across Asian screens, but like the implied open just told you, for us, it's still probably going to be a bit of a cautious start, 58 points lower at this point in time. Okay, so let's welcome in our first guest on the show. Matt Orton, Chief Market Strategist at Raymond James, is with us. Matt, great to have you in. Thanks for joining in. You follow Indian stocks in the India market very closely. I don't know if you follow cricket, but I can tell you that cricket is dominating markets at this point in terms of mind space. It was a fantastic evening here in India yesterday. But anyway, you tell us, when it comes to earnings and the way these numbers are rolling through, are they looking good or not to you?
Hey, good morning, Surabhi, and congratulations to the Indian women's team. Certainly a great victory over South Africa and even Australia before that, just to get into the final. So very, very exciting. And the market, like you said, is also exciting. I think earnings across the board are coming in fairly strong in the U.S. in particular. We got through the busiest week of earnings in the U.S. last week, and the results across all of the hyperscalers were pretty good. And I think the most important piece of the earnings picture coming out of it is the fact that the capital expenditures are going to continue. So we should see the entire industrial complex, all of those AI tangential trades continue to work. So I think it supports this notion that AI isn't a bubble that we've talked about before, but it provides a lot of strong momentum, I think, for risk on to continue. And that's both in the US and globally speaking.
Got that, Matt. Good morning. Good to have you here. Between US and China, on Friday, there was a bit of disappointment. Maybe, what we heard from President Trump and China was a bit underwhelming, because I guess a lot of it was advertised very heavily as well, that there will be de-escalation, etc. What do you make of it? Is it does it meet expectations, or this is a temporary pause in what is a long-running strategic competition?
Yeah, Prashant, I think the fact that expectations were heightened coming into this, I think they just got ahead of themselves, because we should never expect a full trade agreement to actually come out between Trump and Xi. I think a best case market scenario, and my expectations heading into this, was that we'll agree to kick the can further down the road, and we'll come to some sort of settlement on at least a few of the main issues that the market needs. And at the end of the day, the effective tariff rate on China has come down fairly meaningfully. So that should be a win for the market. It provides additional clarity with respect to the direction in which tariffs are going, although there can always be some ups and downs based on announcements, but it seems like the direction of travel is lower. And that's good enough for the US markets, and really I think global markets, to know that we're not going to have economic calamity or a significant shock to the system persist for any significant amount of time. So I think on the margin, it's a net positive, but we certainly shouldn't expect to have any major breakthroughs in the near future.
All right. Hi, Matt. Good to see you as always. What about the Indian markets? Have you done any kind of churning, any kind of switching? If you could fill us in with anything you've sold or bought in the Indian markets.
Absolutely. So, Nigel, coming into this, I've been optimistic on India, and being selective has been the key to success in this market. So I've lightened up on some positions where we've seen continued weakness. There's no point on holding significantly overweight positions in some of those when other parts are working. So I've lightened up on ICICI Bank, still hold it as a core position, but some of that relative weakness has been shifted into names that are working better, that I've owned for a while, like HDFC Bank. So I think that's a very good trade. And Adani Ports is a name I actually added after I was in India last June and met with the management team. And that's a name that's continued to work really well. I expect to see good numbers coming out of this. And I really like the execution that the management team has been doing on really trying to capture bigger wallet share from clients. So that name I've pushed higher. And depending on how results come from M&M this week, if they're strong and there isn't a robust market reaction, I'll continue to add to my overweight position, just because that's such a high quality name that gets you exposure to a premium asset with a growing middle class consumer in India. So there's a lot, I think, that there's to like in India, and hopefully we'll continue to see this trend of higher highs, higher lows continue, and maybe finally we can break out of last year's high to really start to push higher over the long term.
Okay. All right, Matt. Look forward to that, actually. So thank you very much. Great conversation as always. You were super week, and we'll catch up again soon. Thank you for joining.
Thank you.
All right. Well, with that, let's move on and tell you about the top 10 stocks that we will be covering. Lots and lots of stock-specific action over the weekend. So here are the names that we're looking at. BPCL, Godrej Consumer, Bank of Baroda, Patanjali Foods, RRK Bill, CDSL, Felix Mills, all those on the back of positive news flow. Then there's Urban Company, Tata Chemicals and JK Cement, which could potentially open out on the negative side, and we'll tell you why in just a bit. Welcome back. So like we've been telling you, plenty of news flow over the weekend, lots of earnings as well to go over. The implied open is still suggesting that we'll be probably 50 points lower at the start. 48 thereabouts. So let's now drill it down to individual stocks that you should keep your eye on. Our team is standing by with the CNBC-TV18 list of top stocks to watch. Guys, morning to all of you. Lots of numbers. So let's start with BPCL. Sonal, morning. How do the numbers look?
Well, the numbers were good this time around, slightly lower than the poll, but refining margins were really strong. So if we look at the numbers, margins came in at 9.3% versus 8.6%. Remember, the poll was 9.9% this time around. Profits were up 5% at 6442 crore rupees. Now look at the GRM number, $10.8 per barrel, which compares with $7.5 per barrel. So refining margins were really strong. However, marketing volumes excluding exports, they fell 2% on a YOY basis. This is when the industry grew 2% this time around. There was a market share loss as well for BPCL of 80 basis points on a YOY basis. But the numbers overall were good, on the back of which Nomura has raised the target price to 470, and they've raised FY26 EBITDA by 17% on account of higher than expected refining margins amid strong outlook for diesel cracks. And Jeffrey says that valuation for BPCL is more favorable versus the peers, and that's why they have raised their EPS estimates by 25 and 23% for the next two fiscals.
Got it. All right. Thanks for that, Sonal. Let's hop across to Mangalam. Mangalam, Godrej Consumer, decent numbers, and they've done some inorganic growth as well. Tell us more.
That's correct. So if you look at the numbers, the street already had an inkling because of the cheat sheet that the company had given. So largely in line set of numbers, revenue at 3825 crores. The street was working with a number of 3850 crores. EBITDA at 733 crores. Our poll threw up a number of 731 crores. So absolutely in line. The net profit on a reported basis was a bit of a miss, 459 versus 493. But that can be explained by an exceptional loss of about 30 crores. So you add that, that becomes in line as well. Domestic volume growth at 3%. The street was working with a number of 1 to 2% as well. Home care business grew by 6% and personal care degrew by 2%, led by disruptions due to GST. The management says that going forward, they believe that margins will only improve. But add to all of that, they've gone ahead and acquired this company called Moustache, which is basically a male grooming D2C company. For over 2 tranches, they will pay about 450 crores. The company did a revenue of almost 80 crores, so scalability of that would be extremely crucial to track. Seeing mild green on Godrej Consumer on account of the acquisition, inline set of numbers and management commentary, which indicates that going forward, things are only on the mend.
All right, Mangalam, thanks very much for that. We'll talk more about Moustache later. That's quite a name, right? I mean, right out there.
Moustache, actually.
No need to wonder. Sorry, what is it called?
Moustache, if I remember that correctly. It's quite a name.
But it's pronounced Moustache. I mean,
yeah, it's a pun on the moustache. I see on the screen only Gaurav is the one that has one.
All right, well, Gaurav, you may want to pick up on the offer Mangalam is making. Bank of Baroda, though, also reported numbers. So run us through the numbers there. Morning.
Yes, when we look at Bank of Baroda, two things which actually make the bank stood out well in the results. First is the IT refund and second is credit cost. So when we look at IT refund, company got around 750 crores of IT refund, and that is the reason why when we look at net interest income, that increased almost by 2% on a year-on-year basis. When we come to PPOP, which is pre-provisional operating profit, the support from other income that was missing because treasury yields that decline, and that is the reason why PPOP declined almost by 20% on a year-on-year basis. But another push that came was from the provisions. Now, when we look at provisions on a sequential basis, we are seeing a sharp improvement in provisions because of the international business, and that is the reason why profit that declined just by 8%. It was at a bit higher than the street's expectation. When we look at the net interest margins, now the positive surprise came here because of the IT refunds. Net interest margins, they expanded almost by 5 basis points on a sequential basis. In fact, from here on, they are guiding for stable or some kind of increase in the next quarters for net interest margins. And credit cost, that also declined almost by 26 basis points. Now it stands at around 0.29%. So definitely a positive move was seen there. And as a result, we may see some kind of uptick in this stock today.
Okay, Bank of Baroda also looking good. Thank you for that, Gaurav. Back to Mangalam then. Mangalam, Patanjali Foods, how did it look?
Well, Patanjali Foods was actually a lot better than what the street was fearing, and this despite the GST-related disruption. Why do I say that? Because the weakness in edible oil margins were actually offset by strength in FMCG. Quarter on quarter, there was improvement in even edible oil margins, and FMCG results, which include the consolidation of home and personal care business of Patanjali that they had bought earlier. And there was a 141 crore tax credit as well that has boosted the net profit. So 21% revenue growth, near 20% growth in EBITDA, margins stable at around 5.6%, and the net profit coming in at 516 crores, aided by that 141 crore tax credit that has come in. Edible oil, the revenues grew 17%. The EBITDA grew just 2%, but remember, quarter on quarter, there has been an improvement. And FMCG business, which includes the consolidation, saw 30% revenue growth, 51% growth in margins. So the margin accretion playing out for them. I see green on Patanjali.
Thanks a lot for that, Mangalam. Hopping across to Vinny. Vinny, tell us about RR Kabel as well as CDSL.
Hi, both these companies have reported their Q2 FY26 numbers, good numbers coming in from both of them. Now, firstly, talking about RR Kabel, good revenue growth of around 20%, mainly led by the wires and cable segment, which saw very good growth. Volumes over there were up by 16% as well. That was in line or better than what the street was expecting. Margin guidance over there was also good. And that's why when you look at it, even in terms of the profits of the company or the EBITDA margin, that has also seen a good improvement versus last year as well. Profits up 135%, margin at 8% versus 5% as well. Only the FMEG segment, that's where a bit of a subdued performance is what the company saw. But green is what we're expecting here. CDSL also, we're expecting green here. Good growth in terms of revenues on a sequential basis. EBITDA margin at 55.7% versus 50.4%. Now, obviously, what's leading to the good growth? It's better than what the BBG estimates were. That's Bloomberg estimates. IPO and corporate actions, that was also up by around 200% since last year. And the income now, IPO income accounts for around 19% of the revenue versus just 8% in Q1 of FY26. Good revenue growth across other segments as well, and that's why green expected here.
Okay, all right. Thanks very much, Vinny, for that. Let's talk about Urban Company now. Mangalam is back with us with that one. Mangalam, morning.
Morning. So it's the first consolidated or quarterly performance that the company has reported ever since its listing. There has been a sharp contraction in India margins because they've upfronted some of the investments, and at the same time increased investments in InstaHelp has actually dented their EBITDA further. If you look at the native purifiers and door locks business, there has been a strong growth out there, and the reported revenue in international business has been slightly slower because of the deconsolidation of the Saudi business. So if you adjust for that, there's a 44% growth. So what exactly is the company saying? They will continue to invest in InstaHelp. They expect a consolidated EBITDA losses to continue in the near term, and ex InstaHelp, the EBITDA is actually a positive 10 crore rupees. Revenue reported basis grew 37%. The EBITDA loss increased from about 16 crores to 68 crores. And the net loss increased from about 2 crores to 59 crores. Where the stock goes today depends on what your analysis for the stock is, or rationale for investment is. If you're investing for growth, then growth is maintained. And if you're investing for profitability, then you may have to wait for a little longer. So I see some red in Urban Company because of the mood of the market right now.
All right, Mangalam, thanks for that. Moving to Sonal, tell us about Tata Chemicals as well as Phoenix Mills.
Well, for Tata Chemicals, it was a weak set this time around, Nigel. It was a decline, revenues down 3%, EBITDA down 13%, margins at 13%, but profits saw a bigger dip, 42% on a YOY basis. Company said that soda ash prices remain weak across geographies, and in certain instances, it is actually at record lows. Global demand is also expected to be flat in near term, so even the outlook is not so positive. Going with red there. And for Phoenix Mills, on the other hand, it was a good set. They saw revenue growth of 22%, EBITDA growth of 29%, margins expanded 400 basis points, and profits were up 39% as well. So see some green on Phoenix Mills today.
Okay, all right. Thanks a lot for that, Sonal. Well, I'm talking about JK Cement, and the numbers appeared like a bit of a miss, particularly if you look at it in comparison to Jeffrey's estimates. So it was a 5% miss on that front. The revenues came in high by close to around 18%, so that was good. And what is encouraging is the consolidated sales volumes as well were up close to around 13%, with grey cement sales up close to around 16%. They're clearly outgrowing the market, which is good. However, on the operating front, the street expected more because, it came in at around 450 crores, or the street wanted a number that was a little bit higher than that, at around 470 crores. And if you look at margins, yes, on a year-on-year basis, there's a good expansion. However, on a sequential basis, there is a sharp compression, which the street may not like too much. Power and fuel cost as well did spike up, and that was one of the reasons that the operational cost was a little softer, operational performance a little softer than what the street was working with. Profit number came in higher, but not as much as what the EBITDA number came in higher. The net debt number has moved up because of the big adventurous, capex plan that they're undertaking. So the stock has already corrected close to around 18% from the recent peak, but maybe some bit of red to kickstart trade because it's a marginal miss on the EBITDA front. From cement, let's move on to metals. And the first management on the show is Vedanta. Well, it reported a pretty good set of numbers. The aluminium segment, that's looking extremely good. To help us out with how the last quarter's numbers were and what's the way ahead, we're joined by Ajay Goel, the Group CFO at Vedanta. Hi, Mr. Goel. Good morning. Thanks a lot for joining in. Well, the aluminium business, that's shaping up very, very well, right? Let's focus first on aluminium and the global demand-supply dynamics. How is it playing out, and how do you expect pricing to shape up from here on?
You're right. I mean, across the Vedanta portfolio, and aluminium has come a long way. If you look at the last quarter, aluminium growth in EBITDA is about 35%, and our EBITDA is more than 5,500 crores, which is more than 45% of total profit pool in Vedanta. Looking at the pricing over the last couple of months, the pricing in aluminium is upwards of $2,850 per ton. Globally, aluminium remains a metal in demand. It also remains a substitute for the green metal. We do see in near future, the demand for aluminium remains lofty. In that case, pricing will remain elevated. The second lever in terms of profit in aluminium is our cost of production. And over the last couple of years, Vedanta's efforts strategically has reduced cost of production by almost 27% over last 2 years. So we do see that aluminum business in Vedanta portfolio remains our highest profit business over next couple of years.
Well, that's right. That business has scaled pretty well. But just getting back to that point on aluminium pricing, we expect it to hold around current levels. And also, since your alumina plant, the second plant has got commissioned, how much lower can your cost of production for aluminium reduce by?
Yes. So in terms of the pricing for aluminium, we do see it over the near future. It will be between the range of $2,850 per ton to almost $3,000 per ton. Now, coming to aluminium cost of production, as we know, Vedanta's integration on supply chain in terms of our refinery in Lanjigad is coming live as we speak. In that case, our COP from the current almost $1,850 per ton will go down to almost $1,750 per ton. In that case, our margins will be more than $1,000 per ton.
Okay, all right. Mr. Goel, Vedanta Limited has been doing okay, but the question is what happens at Vedanta Resources? And out there, you'll have deleveraged the books considerably. Now, the question is, will the dividend payout as well reduce? Because otherwise, you'll be paying out dividend primarily for Vedanta Resources. And now, do you think the focus will shift on deleveraging the listed entity, Vedanta Limited?
At Vedanta parent, Vedanta Resources, over the last 3 years, our debt has come down from 9.1 billion to about 4.5. So at VRL, we are at historical lowest debt over 1 decade, and that trend will continue. In Vedanta India, the operating company Vedanta Limited, you may have seen it's an OpCo, and that too on a high growth path. Maybe the right metric to look at, in fact, is net debt to EBITDA, which has improved from almost 2x a couple of years ago down to 1.4x. So we do see at VRL debt going from current 4.5 billion to 3 billion. At Vedanta India, our leverage going from 1.4x to 1x. So both VRL and Vedanta India will keep deleveraging in near future, mostly from operating free cash flows.
All right. So Vedanta Resources, Vedanta Limited, both of them, the debt will reduce out there. But the street is very confused. Why would Vedanta bid for JAL? Now, there are very few synergies according to the street. Tell us, give us the rationale. Besides the power assets, the street is a little bit confused on this front.
Right now, the entire process of JAL acquisition is a work in progress. And as you may have seen, we got approval in terms of Competition Commission of India. The COC, the Committee of Creditors, is yet to vote, and that will take some more time. The key reason to acquire Jayaprakash has been our interest in the power business, which is more than 2 gigawatt, including hydropower. The remainder assets remains an opportunity. Maybe let us leave it there for now. We are very confident that Jayaprakash is coming to Vedanta.
Let's focus on the steel asset then. There's been some confusion. Scale up or sell? What is the current plan?
We work on both the path. Our position on our steel business has not changed over the last couple of years. As we look for the right valuation, Vedanta has grown both organically and at the same time through acquisitions. We haven't sold assets, but at the right pricing, Vedanta remains open. Look for disposing our steel business. At the same time, we keep investing for growth at steel from current 1.6 million ton per year to 3 million tons. So both growth and potential partnership can coexist, and they will remain coexisted.
Let's focus on the biggest trigger for the stock, the demerger. And the question is Vedanta ready to give a bank guarantee to the Ministry of Petroleum to cool down their concerns with regard to the demerger? Will you do that?
So you may have seen in the last NCLT hearing, the SEBI has approved Vedanta's demerger. And the next date of hearing, in fact, is on 12th of November. And that hearing we see as conclusive. Vedanta is agreeable to keep the corporate guarantee in case if that's a requirement. But we are very, very confident that a demerger will reach conclusion by end of fiscal, as we have earlier committed.
Okay, all right. Thanks a lot, Mr. Goel. We'll hold you to these numbers, and you're sounding optimistic about the demerger. We'll have to see, how and when it does get cleared. But appreciate you joining in. Well, time to slip into a short break. Up next, we have Dharmesh Kant of Chola Securities. He'll be joining in for some fundamental stock talk. Stay with us.
Welcome back. The countdown to India's most prestigious business awards has begun. The jury of the 21st India Business Leader Awards met in Mumbai to pick the winners. They included the biggest names in corporate India. We caught up with two industry captains, Kumar Mangalam Birla and Sun Pharma founder Dilip Shanghvi, on the sidelines of the event. Shanghvi said he was confident about the outlook for growth in Europe and America. Birla, who also chaired the IBLA jury, said he wants his group companies to be in the top two across sectors and industries.
My own assessment of our industry is that it's a very stable industry because pharmaceutical products are used for treating patients who are not well, and that's a process which gives us much more consistent business. However, globally, internationally, there are changes which are happening, especially because of certain changes in Europe and US. But fortunately, I think pharmaceutical industry has not been affected because there are no tariffs likely to be imposed.
And what do you think is your message for the pharmaceutical industry right now? What are the challenges that, according to you, they're facing? What are the opportunities here? What are the threats?
I see a tremendous opportunity for pharmaceutical industry. India already is the, what you call, pharmaceutical export or pharmacy of the world. So we are largest exporter of generic products. I think what we need to do is catch up on innovation, and that's something which I see significant progress being made.
I think being in the top one or two in the industry that they are in, with return on equity, that's specifically each one's target. Largely, that's how we work.
Are you particularly chuffed about some of the forays that you've made, especially in the consumer space? With the GST cuts that have happened, that would boost consumption and the money that people have in their hands. Have you seen that on the ground?
Yeah, I think they had a very good Diwali. I think both paints and as well as retail, jewelry retail. It's our first time with such sort of hardcore consumer brands, and it's good to see them having taken off so well.
How happy are you with what you've done? And obviously, it takes a lot of capital commitment to that as well. So,
I think both have gone off to a great start, much above targets and much better than I had expected.
Okay, and we'll continue to get you more voices from that IBLA jury. It's, of course, run up to the actual event, but really illustrious jury deciding on, who the prizes go to. This is the most prestigious award as far as the Indian corporate scene is concerned. Dharmesh Kant is with us, Head of Research at Chola Securities. Dharmesh, great to have you with us here. Good morning. Thanks for your time. So I'll just start. It's an open-ended question. Lots of numbers have come through, and we highlighted some of them with our research team. Any which stands out to you with regards to today and how stocks may move, Dharmesh?
Yeah, good morning, Prashant. Thanks for having me on the show. Yeah, see, numbers have come through and there has been sectoral divide between, there are few sectors which have done pretty well as far as the numbers are concerned, but they are priced to perfection, and there are few sectors where the numbers were good for Q2, but the future trajectory is not looking very encouraging. And then there are few where the numbers are also better and the future outlook is also good. So there, I think the BFSI space, the entire BFSI space, be it NBFC, banks, public or private, they are looking quite encouraging. Defense companies are looking far better. And mid-cap IT companies, which are more into the servicing part, they are looking far better. For example, Newgen Software came out with a good set of numbers. Network Technologies, again, the numbers were strong. And the deal wins were pretty strong. So I think their attraction will continue. In lines with, say, Persistent, Coforge or Signity, all have reported a good set of numbers. So these are the baskets where I think the attraction will be there. One caveat I would like to highlight right now is, as far as automobiles are concerned, October numbers were great, considering the fact that last October, both Navratri and Diwali fell into the same month, and this time you had only Diwali. But this euphoria is now, subsiding. Our dealer checks do suggest now it's business as usual. So November numbers won't be great. So traders who were there into these pockets are advised to, take profits. There may be few outliers. I mean, Maruti can still see attraction going forward, but valuations are now sitting on the higher side. So one has to be very selective on what you are picking up right now. But sectorally, I think BFSI, the entire space looks attractive, followed by, a few of the mid-cap IT companies and defense companies.
Dharmesh, hi. Morning. Good to have you in. So let's talk about new age businesses. They're always very exciting and always stir up a debate, right? I don't know if you had a chance to look at the urban company numbers. Manglam was just telling us that because they're investing more in this Insta help business, there's again some cash burn happening. So profits are again coming under pressure, but the growth is there. Talk to us about that. What do you thought of Swiggy? Swiggy is raising more money. And then if at all, throw in a word on Lenskart as well.
Yeah, good morning, Surbi. I mean, again, like quick commerce, InstaHelp is getting into play. And this is more of a 30-minute kind of a house help business which should be there. Normally, these are like ad hoc kind of an business opportunity where your regular help is not coming, you order for them. So again, cash burn is there. The thumb rule which goes by for a company which has been into a new age business for say 3-4 years, it's like that your revenue growth should be higher than your cash burn kind of a growth. So, but in this case, right now, the operating profit degrowth it has gone to around 20% if I am not wrong. And management did cite that these losses are going to continue. So that does pose a question mark, and you have a competition also coming up in that space. Though it has all the services, say house help, electric, plumbing, beauty, therapy, and personal care for, especially for Nigel. So these services are there, but to my sense, again, they are expensive. Swiggy, the cash burn was, again, a surprise why they need to do that with so much, cash already lying on the balance sheet. That does specify one thing very clear, that competition is very high, and 1-2 years it will take before they can come to meaningful profitability. Lenskart, we have a clear avoid rating. I mean, it's exorbitantly priced, and if I may quote Mr. Shankar Sharma's article, so he was right. You price it so high that even if it falls, it looks, cheaper. So, and it's a, well-discovered business. They are into every nook and corner of the country. There is no domestic penetration where they can have an higher yield. And the growth rate has been tapering on the revenue count from 43% in FY24 to 23. And it will be 15-16%. International opportunity can be there, but the margins again will be under pressure. So, I mean, new age businesses, you have to be very, very careful.
Yeah, exorbitantly priced. That's the term that you've used. And yeah, absolutely. Shankar is really in the eye of that Lenskart storm, right, with that article. By the way, Dharmesh, what did you say? Which service that Nigel perhaps will make use of? I missed that.
I mean, beauty care therapy and massage therapy, which is, he likes them.
Tell us more.
Nigel, that's the secret behind the radiance. Now we know.
I mean, I've never used the service actually for a massage, but I will. I have always thought about it. Yeah, I mean,
the glow.
Yeah, because at times I ask the wife, that instead of me going out, if we could arrange. But I think most of the time it's booked out. But I'll take that recommendation, Dharmesh, and maybe but yeah, that you need to ease out things. All right, Dharmesh, what else? If you could tell us about a couple of these names that we were discussing earlier. Vedanta came out with its set of numbers. The stock pullback, there was a one-off in those numbers actually. The street is sounding optimistic about prospects, on the stock. The problem is demerger. Will it happen or not? And the promoter is, a tricky entity. So what's your view?
Yeah, definitely. Nigel, you summed up that promoter is a tricky entity, and financial engineering, re-engineering, they are, prone to that. Time and again, they keep on doing that. Otherwise, business, if you look at the businesses sounding great, the entire global environment is sounding great for the businesses they are into. And I mean, on the revenue count and operating profit level, the numbers were excellent because of one-off write-off, the PAT went down. But again, one is the demerger case, which is pending, and let's see how it shapes up. And secondly, the assets they are trying to acquire, which is not related to their core business. So all the business verticals are not performing that well for Vedanta. At the same time, when silver prices were shooting up, they did not produce more because of lead being produced less. So there are challenges out there. Having said all of this, if you just look on the pure valuation multiples, it's pretty attractive compared to any of its peer, be it Hindalco or others in the basket. If you look at valuations are comfortable. The only thing they have to address is that corporate outlook strategy stability out there. At the same time, what they are doing with their cash flows, either they are paying dividend or you want to repay the debt and make company more secure. To my mind, the latter should be more beneficial for the company in the long term. So I mean, people who can give a benefit of doubt and things that things are going to fall into place for Vedanta, then it's a screaming buy. But if you are a skeptic, then wait for this clarity to come by and then venture into Vedanta.
Okay, all right. We'll leave it there. For now, stay with us, Dharmesh. What we'll do is take a quick commercial break here, get you some technical trading ideas as well. So Siddharth Rai Mangla and Mitesh Thakkar are with us today to run you through specific trades on the indices and stocks as well. Stay tuned.
Welcome back. You're tuned into Bazaar Morning Call here on CNBC-TV18. As promised, we have Mitesh Thakkar as well as Siddharth Rai who join us on the show. Hi, good morning, gentlemen. We are pumped up in the studio after last night's win. The girls in blue are doing us very, very proud. But the markets have been a little under the weather just for the last couple of trading sessions. Mitesh, you go first. The gift Nifty suggesting we pull back 50-60 points. Buy the dip or wait buy?
Morning. We've been advocating that there could be a pullback because the market was struggling around the previous highs, which is around 26,150 to about 26,220. Though we never got to 26,150, but we had, just kind of touched that level. Having said that, we had first indicated a possibility of decline to 25,800 and in a bad case scenario, even 25,600. Looks like, we might actually go down to 25,600, but till we break below that, I would be pretty okay, and believe that the broader trend is on the upside. So having said that, I think, today's gap up opening, which is around 50 points, may not do much. But in case during the day, if there's some choppiness and if you get a decline on an intraday basis with Nifty closer to 25,600, that is when I would want to explore long positions on the index and even stocks aggressively.
Gentlemen, morning. Siddharth, what about you? How would you look at indices first?
Hi, Prashant. Good morning. Thanks for having me. See, Prashant, if we talk about Nifty, there was a very major change which took place in Nifty on Friday's session. See, there was some hope till Friday that eventually after all this volatility, there will be a recovery towards 26,000, 26,100, those levels. But since we saw a very big breakdown below 25,800 and, adding fuel to that fire was a closing below 25,800, which is why I think now it will be much better to just stay with the trend, and the trend is negative. So as long as we are below 25,800 now, we should look at this fall extending towards those big levels 25,600 and 25,550. Those are the next important supports for Nifty. So as long as we are below 25,800, our view should now be bearish in Nifty.
Okay, all right, got that point, gentlemen. Morning to both of you. Let's also, get down to stocks. Mitesh, let's hear your list first.
Good morning, Sylvie. I have a mix of buyers and sell calls. On the buying side is BEL, which bounced back from a support level on Friday. So keep a stop at 419. Look for targets of 440 here. Aurobindo Pharma is a buy as well, with a stop below 1190. For targets of 1175 to 1180. And on the selling side is Eternal. The key short-term support of 320 was broken. So sell in the range of 316 to 320 with a stop at 326 and a target of 305. And ICICI Bank is a sell with a stop at 1363 for targets of 1310.
Okay, got that, Mitesh. Siddharth, what about you? Which stocks are you working with today?
Hi, Subhi. Good morning. See, just like Mitesh, I have both longs and shorts on my radar. Just because I said the market does not look very strong as long as we are below 25,800. So it's much better to keep a balanced approach right now. So two stocks are there. The first one we have to buy. The second one we have to short. The first one, the one we have to buy is IDFC First Bank. See, Subhi, consistently we have seen this stock making new highs for the past 2 weeks, but a breakout above 80, which came in Friday's session, was very big. So now there is a fresh momentum building up, which can take the stock towards those 90 levels. So IDFC First Bank can be bought. Right now, the spot is trading around 81.8-ish. So it can be bought. The stop loss will be at 78.5. And our targets being, the first target is 89. The second target being 92. The second stock is Fortis Healthcare. And this one we have to short because for the past probably 6 months, the stock was in a very strong uptrend. But just in the last 7-8 sessions, there have been signals of a strong turnaround. It has fallen quite a bit in the past 7-8 sessions. And even now, I think just if the ticker goes just below 1,000 for a while, it will be a very sharp correction, which can extend towards 960 levels. So Fortis Healthcare can be short. We can go short on this stock. Right now, the November futures are trading around 1027, 1026. You can short this one. Our stop loss will be 1048, and our targets being the first target around 980, second target being around 965.
Okay, all right. Siddharth and Mitesh, thank you very much for joining us for now. Come back to you in about 12, 30 minutes for 9-10 calls. Appreciate it. We'll take a quick commercial break here. The pre-open session comes up in just a bit. We'll also have Shankar Banerjee of Dr. Lal Path Labs. They reported numbers. So a conversation about about Q2, but of course H2 as well. Stay tuned.
Welcome back. 15 minutes to go before the trading action for the day and the week kicks off. We are still going through plenty of numbers, and Dr. Lal Path Labs is the next company on our radar. It reported an inline set of numbers for the second quarter. Revenue was up about 11%. Margins came in at a healthy level as well. We have with us Shankar Banerjee, CEO at Dr. Lal Path Labs, to take a couple of questions. Mr. Banerjee, thanks very much for joining in. So I'm looking at some of the details. We'll just pull up the financials. At the end of the first half of the year, your revenue is roughly at about 1,400 crores. Your margin has risen to about 27.5%, and we have the quarterly details flashing on the screen as well. So that's the growth in EBITDA for Q2 per se. And Q2 margins up on the screen looking very, very healthy at a little over 30%. First things first, just walk us through what led to this kind of an expansion, and is this margin level sustainable?
So, thank you. Good morning, and thanks for having me. Firstly, this is, like you said, very much in line with what we had said for the year. We have guided 11 to 12% revenue growth, and we are kind of on track for delivering the same. So first half is in line. So last year, we had taken up some kind of action in terms of increasing our testing infrastructure and our collection infrastructure, which usually takes some time to mature. And, we are seeing some of the benefits of those actions and other actions that are also underway. On the margin front, the second quarter is usually the best quarter for us, and margins are typically high in the second quarter. So the second quarter margins are definitely not a reflection of what the full year margin profile for the company would be. So having said that, we are expecting our full year margins to be in the range of 27 to 28%, which will be, I think that's something we should be in line to deliver.
Okay, so 27-28% margins for the full year, they seem sort of sustainable. For Q2, Can you break up the growth in terms of volume and pricing? Was it largely volume led? Have you managed to take any price hikes? And what's the outlook on pricing in the second half?
So the growth has been primarily driven by volumes and mix improvement. We haven't really taken any price increases. And, that's something which we have been consistently holding on to, given that our growth initiative, needs us to really compete with some of the unorganized players in the smaller towns. So pricing is something which is an important metric to keep a watch on. So this is primarily, sample volume growth, which has come upwards of 10% in this quarter also, closely hugging our overall revenue growth, and some mix improvement that we are seeing. Going forward also, I think pricing is something which we will keep a watch on. There isn't really an immediate plan to take any price increases even in the second half.
Mr. Banerjee, morning. Prashant here.
Good morning.
It was a very weak dengue season this time. And I think for testing companies, I guess, it takes a bite out. Otherwise, there is big business in that sense. But, unseasonal rains are continuing. I mean, it's completely whacked out weather. Here in Mumbai, it's still raining. Is that going to add some legs to what you're seeing?
So it's like you said, it's unseasonal rains, and we had a subdued kind of fever, in Q2, which is usually a slightly better or slightly higher in terms of seasonal flu. So this year it has been more subdued than the last financial year same period. I don't foresee unseasonal rains to really cause any uptake because of fever pattern changing, because there are other factors besides rains which contribute to fever. So not very sure whether that's going to happen. But having said all of that, we as a company don't have a lot of exposure towards fever driving our revenues. I think we are more focused on the specialized business, the non-communicable disease burden, solving those issues, and also our detailed or in-depth working with clinicians across the country. So fever is very small part of our overall business.
Okay, let's talk about Swasthfit as well, and the contribution that's come in over there. I think it's grown 20% year on year. That's the number that I have. Can you walk us through some of the details there, and whether the contribution you expect it to go, grow higher by the end of the year? Some outlook there would help.
So Swasthfit portfolio has been doing quite strongly, and we believe that it has still quite a bit of headroom and opportunity to grow. There are multiple reasons. Firstly, the uptake of post-COVID, the uptake of health checkups has gone up, and we are also seeing traction in the smaller towns where we are reaching out. I think the newer labs and the newer collection network that we are building is also helping us reach more patients, in some of these towns and micro markets. So overall, we still see this growth momentum, higher than our company growth, and substantially higher than our company growth to be there, at least for 6 to 8 quarters ahead. And then we will see how it shapes up, and how we will take this portfolio further in terms of growth.
Okay. All right, Mr. Banerjee, we'll leave it on that note. Thank you very much for joining in, and good luck for the second half as well. So that's some of the detail from Dr. Lal PathLabs at the end of second quarter. It's been a steady quarter for them. Back to Dharmesh. Dharmesh, in case you have a view on Dr. Lal or any of these diagnostic companies, also, by the way, hospitals. As we were ending last week, it was a story that our colleague Yash actually put out, that it seems that hospitals and insurers have come to some sort of an agreement with some intervention from the central government that they will not be taking incessant price hikes, because they're always at loggerheads, health insurance companies and hospitals. It did impact stocks to an extent. There was a bit of a downward pressure on Friday as well on the likes of Apollo. So just give us your thoughts. Hospital stocks that have done exceedingly well, including Apollo, and anything in diagnostics, if you like that.
Yeah. I mean, diagnostics came out with a good set of numbers. Even thyroid numbers were very good, much better than Dr. Lal PathLabs. And self-care kind of health checkups have taken a good trend, and they are getting more traction. So I think that is going to continue. But one thing one has to keep in mind, because Q3 is normally a healthy quarter. So the businesses are not that, great for these companies. So there would be some downtick coming into play. And as the guidance was there, that the margins are going to not be 30% plus, but it will be 27 to 28%. So some, profit taking can happen out there. But I do think Thyrocare, Dr. Lal, looks pretty attractive at current levels, and one can continue as an investment by going forward as corporate health checkups and self-care health checkups makes more traction into the system. Hospitals looks pretty attractive to me. I think this is one segment which is likely to continue with their upside trajectory, though valuations are higher, but that has been the case with them historically. So Apollo Hospital look pretty attractive after the correction. And if there is some more dip because of market correction taking into place, one can buy that. Narayana Health is another hospital chain which we have been liking quite a while. And they have done an acquisition in UK. So their foray into the normal health checkups gains further traction with beds coming into play. And surgeries are on uptake in the UK part of the market. So that will augur well, and it would be EPS accretive for Narayan. Maybe not this year, but FY27 onwards, it will start contributing quite healthy to that. So these are the two hospital chains which we have been liking from the entire basket. Having said that, the entire sector looks pretty stable and attractive to us.
Okay, all right. What about Vodafone Idea? Any view out there? Various reports suggest that probably some money is coming their way. It's unconfirmed, but I think it'll, hinge on what comes out of the government and the Supreme Court. What do they have to say about it? At around 9 rupees, would you look to get in, or do you think that it's too risky? You'd rather stay out of it?
Nigel, it's more of a punt to my mind, because see, even if that IGR things get settled, it's only 30-40% of the total liability on the company balance sheet. So 1,10,20,000 odd crores will still needs to be addressed by Vodafone Idea, and that's a huge liability because the interest burden itself is higher than the operating profit. Forget about the depreciation part. So I don't think these small measures, ad hoc measures, can keep the oxygen flow or the ventilator working for Vodafone Idea, but it's either a ventilator or oxygen flow. It's not that the patient is becoming healthier. So something more drastically, more meaningful has to be done if they seriously want to revive this company. Otherwise, it's a slow, that kind of a scenario for Vodafone Idea to my mind.
I want to say one thing, Nigel. This report of infusion, I think it's come at least 10 times, right? In the last 3 years.
Yeah.
This one is putting in, that one is putting in. So while stock is up for retail investors, it's a trader's favorite because it's a small unit value share. Be careful. I mean, just see what happened last week. It was up 10% and then it was down after the clarification from the Supreme Court, limited amount. So it's very volatile, not for the faint-hearted. I'm not dissing what some of these reports are saying. It's good if it comes in and we need that player, etc. But if you're trading, you've got to have all these things in mind.
I think Dharmesh put it quite well, right? It's not changing things drastically. Dharmesh, very quickly before we let you go, I think the PSU banks, that's been a sector that's been looking very good. If I remember correctly, and you can correct me if I'm wrong, I think Bank of India is a stock that y'all had liked maybe a couple of months or so ago. That stock has done well. Has it played out or more to go?
Yeah, there's more to go because if you look in the PSU basket itself, Bank of India is the cheapest stock available. I mean, it's trading at around 0.7 times price to book 1 year forward. While others in the pack has gone above 1.2, 1.3 times price to book. So that technical de-adjustment of valuation re-rating is there to be on the cards. At the same time, the numbers were excellent, 13-14% kind of an advances growth with asset quality, getting more firmer out there. And the one thing which will play out for public sector banks, this the reported PAT numbers were weak for most of them because of the treasury income reversal. But Q3 onwards, I think if there is no further interest rate cut, this will again get reversed in favor of most of the banks, and then again you will have 15-20% kind of upside. So initial target price which we have been working for Bank of India is 155, but I think going forward it would be revised upwards.
All right, Dharmesh, thanks a lot for joining in, helping us out with that, all that fundamental ideas, and also I'll take your inputs with regard to using some of the services of Urban Company as well, which I have until now. Thanks a lot for joining in. Have a good day ahead, mate. Going back to Mitesh, he's here to tell us about the 910 call. Mitesh, what's on your radar?
I had a mix of buy and sell calls, but for the timing, the stock which I would like to recommend will be BEL as a buy call for targets of 440.
BEL, okay. Got that, Mitesh. Thanks for the call. By the way, just checking some of the stock reactions also and how they're playing out. Bank of Baroda, Gaurav was telling us, obviously, is a good number. We'll just go to Gaurav in a bit. Watch out for RR Cable. Those numbers seem to be going down pretty well with the street, 4% up. And Dharmesh was telling us that he'll be very cautious with the likes of some of these new age companies. And Urban Company is missing the mark. Additional investments in their Insta Help venture. Street is a little nervous about this. 6% down on Urban Company. But let's talk about the winners. I mean, Bank of Baroda definitely looks to be one this morning. Gaurav, just remind us, recap the numbers.
Well, yes, when we look at Bank of Baroda, two key positive things. First is net interest margin expansion and second is credit cost decline. Now, when we look at the numbers, net interest income increased almost by 2.5%. PPOP that declined almost by 20% because the support from other income that was missing because of the treasury income. Provisions that declined almost by 49%. And as a result, when we look at profit, that declined just by 8%. Now, when we look at profit number and in absolute term, it was a bit better than the street's expectation. Now, when we look at the net interest margins, we saw a surprise here because net interest margins increased almost by 5 basis points sequentially. Now, this was also supported by the IT refund that the company got of around 750 crores. And apart from that, another key point is that the credit cost that declined almost by 26 basis points sequentially. And this was largely aided by the international business. We saw zero slippages there. And as a result, slippage ratio that also declined. Now, when we look at brokerages, they are now being a little bullish about it because we have got HSBC who upgraded the target price to 340. Nomura upgraded the target price to 320. And for Investec, they even upgraded the rating to buy and also increased the target price to 325 versus what it was at 250. So definitely bullish call coming up from brokerages as well. Good set of numbers. And at the same time, management also remained optimistic on their con call. So definitely watching out on this stock today.
PSUs and PSU banks were all the rage last week. 2% on Bank of Baroda, BPCL, great numbers at the bottom of the screen. So it's going to be a fair bit of PSUs today as well. Now, record sales for auto companies in the month of October, driven by, of course, festive sentiment, GST demand. There was that sort of Shraddh-related pent-up demand, which all showed up as well. So it is here with details.
So it was the first full month of the impact of the GST rate cut and the festive season, and the sales overall are largely in line or slightly better than estimates. The biggest positive was the CV segment, which is out from all the other segments, while PV and two-wheelers have reported sales largely in line. Talking about Mahindra & Mahindra, auto segment has done better, and it was led by SUV segment and also the new launches that company has made in the month of October. For tractor segment, that is also done better than estimates. Total sales have increased by 27%, 13% YY versus our expectation of around 5 to 6%. Talking about Maruti Suzuki, it has recorded highest ever monthly sales. Total sales have increased by 7%, and that was led by compact segment and SUV segment. Hyundai India has done slightly lower than other peers. Maruti and Mahindra total sales have slipped, and mainly because of domestic segment. Tata Motors has done better.
Right. No, I think so. We'll just look at the market open, and then we will come back to Sud with specifics with some of these companies and reactions up on your screen. So 25,720 is where the Nifty is starting. It's absolutely flat. Nifty Bank at about 57,800. Again, absolutely flat. Bank Nifty, the mid-cap index is 60 points higher. The small-cap index will come up on your screen, and I think there as well, there is about a 50-odd point bump. A 0.25%, 18,430 is where we stand at. So that's the overall picture. Nifty heat map coming up on your screen, and I think it's absolutely evenly poised. Look at that, not even a 1 point change on the Nifty. And I think it's kind of balanced like that on the Nifty stock-wise as well, right? So Shriram Finance on one end, and there is Maruti on the other end. So equal number of stocks up and down this morning. Surbhi.
Okay, by the way, in result reactions, I was talking about RR Kabel. That stock shot up 7% now. Their margin went from 4.8% to 8%. In this quarter, and we'll be speaking with the management shortly to figure out what exactly has driven this, but just watch out for that. I mean, it's really an earnings bazooka out there. Anyway, large cap screen, let's see what's moving. Shriram Finance doing pretty well, 3.5%. This is also management that you'll hear from in just the next couple of minutes. 4% up, but Shriram Finance is having a fantastic morning. Then we come to the auto majors, all of them revved up. Mahindra & Mahindra 2.5%, Tata Motors about 0.5%. Bajaj Auto's numbers just came through. They've again done over 5 lakh units in the month gone by. So about 0.5% up on that stock as well. But then it fizzles out. The Nifty is, by the way, 50 points lower. Reliance is at the flat line. It's flashing a little bit of red right now. L&T is cooling off. And then you have Eternal that's still slipping. Friday, Eternal was down almost 3%, remember? It's down another 1% this morning. There's some cool off on the likes of ITC. Then some of the bigger, stocks like HUL and TCS are, undecided, about 0.5% lower there. Maruti is slipping a lot. Maruti is down about 3%. So we'll read through the fine print on the Maruti numbers. The question is, sustainability, and that's where it's all about. The stocks rallied quite nicely, but will this post-GST bump sustain, or was it a 1 or 2 month wonder? That's the question. Anyway, that's the large cap screen for now. 60 points lower, but some green on the mid cap screens, Nigel.
Well, that's right. Zen Technologies, the stock is locked up, with a gain of close to around 5%. They've seen order inflows of around 290 crores towards upgradation of the anti-drone system and executable, and that's executable over the next 12 months or so. In fact, it's up 5.5%. It's not locked in upper circuit. So 6% higher, good move out there. Astra Micro as well, order of around 286 crores secured by their JV. Astra Rafael Cummins, that's another stock that's up close to around 1.5%. As should be mentioned, RR Cable. That's the result reaction of the morning on the upside. But giving it company on the upside is actually LG Balkrishna. That, remember, is that auto ancillary company that has a good play with regard to two-wheeler chains as well, and they've been doing various ways to re-innovate the business. The stock is up close to around 11% now as we speak. I recall we here at CNBC-TV18 had explained the company a few years ago. It seems they went to a bit of a trough and now they're coming out of it. I think we'll have the management later on today joining us, 10% higher out there. GNA Axles is another stock that's up close to around 3%. Decent volumes on that one. The reactions actually that are not very, very favorable are two of them. One is NetWeb. The stock is up close to around 30% year to date itself. The numbers look pretty okay. There is some growth on the top line. Margins as well are more or less steady, but I think it ran a little bit ahead of itself. That's the way the street is reading it. Margins steady at around 14.8% or thereabouts. Revenue growth is there 20% year on year, but the stock getting smacked. And Urban Company, that's a stock that's down close to around 6% as we speak. Big downtake on that particular name.
Okay, no, absolutely. And so that's essentially, some earnings-related reactions which are coming through. Maybe if I can just add a few more names here, which are the biggest volume-led gainers. Bank of Baroda is top of the list with the largest volume traded, 4% higher. Shriram Finance is at number 2, so financials dominating, 5% on Shriram Finance. Now that's a big, the second largest NBFC, and you'll hear from the management a little later here on the program. And there's a big reaction to results. Naveen Fluorine is at number 3. It's a 4% pop on Naveen Fluorine. So almost 5,910 on that one. RR Kabel, we mentioned, 5%. Godrej Consumer Products, Mangalam has been telling us 4% on Godrej Consumer Products, 1,170 on that one. Vedanta, you heard from the management, is a 2.5% pop coming through. And there's more. I mean, it's not for nothing. Volumes are pretty good. MedPlus is up 6%. Volumes are yet to pick up in a meaningful way, but they're not small either for this point in the day. V2 Retail is 5% higher. I think that's the daily limit. There is IIFL, which is up about 4%. Intellect Design is up 7%. Intellect Design has moved up very, very sharply. Thursday's close on Intellect Design was 1,050. It's at 1,210 this morning. So Friday was a big move on Intellect, and this morning again, it's a big move on Intellect. So, I mean, there's enough and more action. Nifty has kind of reduced its losses. It's down just about 25 odd points at this stage, 25,700 on the index. Pankaj Murarka is CEO and CIO at Renaissance Investment Managers. Pankaj, good morning. Great to have you with us here. Thanks very much for joining us. Let's just start with this PSU theme, which is once again kind of sort of recycling and making a comeback, right? It was the leader of this bull market, and then it took a break, about a year and a half long break. And even within PSUs, lots of different areas which did well successively. But then, I mean, all of them largely re-rated, and then we've had a bit of a lull. But they seem to be coming back once again. OMCs, for example, is a case in point. PSU banks, etc. What do you own here, and what's your thinking about this space now, Pankaj?
Morning, Prashant. Yeah, you're right. Especially with OMCs and banks, we've seen coming back. I think the challenge with PSUs is fundamentally there's a lot of value. These stocks, despite the sharp run that we had in these companies between 22, 23 and the first half of 24, the starting point in 2022 was most of these state-owned companies were trading at like low single-digit multiples. Or some of these companies were available in terms of valuation at 2 times EBITDA and stuff like that, where 2 years of cash flows just, pays for the company. So the starting point itself of the rally was so low that we had a very ferocious rally. But I think the challenge with PSUs is from here on, while these companies continue to do well, the markets needs to see more reforms from governments. And I think which is where probably the anticipation is, because in case of oil companies, at least we've seen government make some clearly nuanced announcements where they said that these companies will not be forced to cross-subsidize across LPGs, and they are now getting paid for the LPG losses that they had in last year, which helps their cash flows going forward. And oil price being benign, the underlying fundamental numbers continues to remain good. And likewise with, I think, with state-owned banks, where they're once again, we've seen a very strong interest in Indian banks. We've seen, over $10 billion of foreign money coming into financial sector in the last 8 weeks. And I think there's some expectations about some reforms in coming budget. Probably it could be another round of consolidation within state-owned banks. And I think which is what is driving interest back into these names. So from a valuation perspective, they're always cheap. I think the trigger point for PSU's rally is always the government actions in terms of reforms, because that is what can really drive a re-rating for these companies.
Okay. Pankaj, hi, great to have you on the show. So tell us on a slightly broader level whether you are looking at the portfolio in any fresh light, any major churn or changes in the last month or two as we've gone through this consolidation and with the market now practically coming back to the earlier highs.
I'll tell you what has worked for us and probably what has not worked, but what I think will going forward work for us in 2026, or how we are positioning ourselves. So clearly, two things that has worked for us this year or in the last year has been private sector banks. They've done well, and I think they'll continue to do well. And the other is our exposure to internet companies. Again, by and large, they have done well. What has not really worked for us is our exposure to IT to that extent. And probably we were somewhat early into the consumer sector. So we've seen some moves in terms of stock price and consumer names. But I still think it's early stages. I think both of these sectors are poised for a meaningful, healthy returns for shareholders in calendar year 26. One, in case of consumption, I think the resurgence in consumption we're seeing post the festival season is actually surprised on the upside. Someone like a Maruti, they've had like 100% Y&Y growth in their festival bookings, and they're running low on inventories on a lot of car models. You have wait periods which are like 6 weeks or 8 weeks, and something like this we are seeing I'm seeing after 4 years. Something like this happened in 2021 post COVID unlocks, and now after 4 years you're seeing that wait periods on cars. So that's very pleasing to hear or witness kind of thing, and which effectively tells us that there's a lot of latent demand that exists, and consumers now have the money in their pocket. So probably this consumption recovery will sustain over a longer period of time. So I think 2026 will see a very meaningful recovery in consumption, and probably I think some point of time this will surprise us on the upside. And secondly, while IT as a sector has not done well, but what has happened is in the last 2 quarters, we have not seen incremental earnings downgrades on the sector. So clearly, earnings have troughed out. And the way macros are poised and the environment is poised, it looks like we are in for a recovery in IT spends, global IT spends going into the next year. So logically, meaning expectation is that the growth for IT companies next year will be much better than this year. And valuations are at trough, and the stocks are down about 17-18% this year, which makes from a valuation perspective even more attractive.
In fact, just keep an eye out. What's good about this earnings season is select companies report good numbers and the street likes it. Intellect Design Arena, just pull up the intraday chart of that stock. It's moved to the high point of the day. The revenues have jumped, I think, close to around 34%. EBITDA is up by 68%. And I think the company has been talking about, 20% growth in revenue in the future as well. They've been saying that they're confident on the trajectory. So just take a look at that stock, up 7.5% as we speak. Pankaj, a more general question to you with regard to the past quarter's earnings. It seems, I was looking at a Motilal Oswal note and various other brokerages as well. Till now, it appears Q2 actually hasn't been as bad as what the street had anticipated. And they're optimistic that things improve from here on, but Q2 has been reasonably better. What's your view with regard to your reading of earnings? And also, if you could tell us with regard to asset allocation, because the frequent asked question now is how much you put in gold, how much you put in equities, how much you put in bond. If you could give us a rough matrix according to you.
Absolutely, Nigel, you're absolutely bang on. The good thing about this earnings season has been that there's been no incremental downgrades. After 5 quarters almost, we're seeing that there are no incremental earnings downgrade. And more importantly, we're seeing some earnings upgrade. So, and I think those earnings upgrade will build on from here on, because probably after having downgrade consensus earnings for almost 5 quarters in a row, I clearly think the analysts are somewhat more circumspect and need to see more evidence of sustainability of growth before they go out and upgrade their growth estimates or earnings estimate going forward. So you're absolutely right. I think we are in the second successive year for India in terms of single-digit earnings growth for the Nifty companies. But more importantly, all of us know the second half of the year, financial year, will be better than the first half. So clearly, we are near the trough in terms of earnings deceleration, and earnings have clearly troughed out. I think we'll start seeing earnings deceleration, earnings acceleration from the second half of this year. So I think the outlook for earnings after almost 5 quarters looks pretty good, and that makes me feel optimistic on the outlook for markets as well. In terms of asset allocation, Nigel, actually, I'm not the right guy, because I've been a 100% equities guy all my life. So for me, there's only one asset class that exists in the world, and that's equities. And there's nothing that excites me more than equities, So my asset allocation is very simple. A bull market or bear market, 100% equities.
All in.
All right, Pankaj, we'll leave it on that note. Thank you very much for joining us. Good to get that perspective on the markets. So all in, and a positive view coming in on stocks going forward. By the way, speaking of positive views, before we get to our next management, just look at Shriram Finance and how the market is standing up and saluting what is an all-round good performance. We'll be speaking to the management shortly. There is no fault you can find in the Q2 numbers. Where most lenders have reported slight compression in NIMs. They've expanded net interest margins by 8 basis points. They're guiding for as much as 15 to 17% growth. All their key segments, CV, passenger vehicle, MSME, everything is firing. ROA, ROE, everything has gone up. So it's absolutely phenomenal what they've delivered in Q2, and the market is taking note of that.
And the other one I'm looking at is Dredging Corp. Normally in a day, you see 5 lakh of volume. In the first 15 minutes, you've seen 5 lakh of volume.
Oof.
Massive volumes on that particular name as well, reacting to positive news flow. So the entire day's volume actually that we normally see on an average, in the first 15 minutes, it's almost fulfilled that quota.
Absolutely. So some stocks that are really on the move, and we'll get to them one by one. For the time being, let's address earnings and numbers that we saw from Kalpataru projects. That is the next management on our radar. It was a pretty good quarter for the company. Revenue growth was driven by robust execution, and it's been a pretty steady performance for them in their key segments. Amit Oplenchwar, director at Kalpataru Projects, is with us. Amit, thank you very much for joining in. So let me just quickly go over some of the key numbers. You've actually increased your revenue guidance from 20 to 25% to now you think revenue will grow 25% plus this year. And you're also looking at a stronger order book guidance. You're saying the order intake is going to be more than 25,000 crores. So tell us where the optimism is coming in from. Which are the segments that really seem to be firing for you?
Thanks, Surbi, and clearly a great win for India, lifting the World Cup, and your T-shirt, all of you, reflects that. So we've in the same line. I think we've had a great quarter. We're at our highest ever Q2 revenue and Q2 profits, and that's very heartening to know. As you said, it's been an all-round performance. Our transmission and distribution sector is doing exceedingly well. Our building and factories, the order spends on single projects are going up 3 to 4 times as they used to be in the last couple of years. Our oil and gas business has shown large growth compared to last year and the year before that. And our urban infra businesses, which we've been seeding now for the last 2-3 years in terms of building capabilities for the future, are all joining the show and contributing to this growth of the company in this quarter and at H1.
Okay, morning, Prashant here. So, you've given us the guidance for this year. What about the top line growth? What does all of this sort of mean for margins? What's the guidance there, and what are the levers at play which could allow you to improve margins as well?
So, three things. First, we said we will try and get to our revenue growth so we've already gone to between 20 to 25%, and obviously we've grown to the higher band of that, and now we've guided for 25% plus at the end of the year, both console and standalone, and that obviously adds to the margin as well when you do more revenue than you had planned. We had already planned last year that, we should try and expand our margins. We said on a console level, we'll try and go 100 bips more at a PBT towards the end of the year. And at H1, we are already at more or less 100 bips more than where we were last year. We've been again focusing on balance sheet and trying to reduce our net working capital days. Our debt levels have gone down further again. We are borrowing cheaper again, getting to, contributing towards our margin profile. The execution has been very low, looking at close to 5.5% on a standalone PBT for the end of the year. Our debt to equity now on a standalone, probably one of the lowest, it's at 0.29, which pretty much debt free when it comes to our business. And I think all of these factors with better margin profiles in sectors as T&D, BNF, etc., a lot of demand in the marketplace, we are able to get better margins. And I think all of these put together are contributing towards the margin expansion.
All right. Hi, Amit. Good morning. Good to see you in. I recall having a chat with you a year or so ago at our JLS event, and you sounded very optimistic, and seems like the numbers are flowing through. So good on you. Just to focus on one segment, which is a relatively smaller part of your business, the water segment. Out there, payments, not just for you, but for various other industry players, have been slow. Could you tell us what is the outstanding in terms of payments coming in from the water projects? And also, I think, what is the trajectory with regard to here now? You were putting in some money, investing in these projects. Will you continue to bid?
So, we are cautiously bidding. We've had a small degrowth in revenue for the water business this year, and that's primarily an industry problem at the moment as we speak. The government is trying hard to unlock the past dues for us. These numbers are close to 800 crores. If you would have got these numbers, our revenue would have been even higher. The story, if you ask me, remains intact. At the end of the day, water is a huge part of being a developed nation, and I think government is fully committed to further putting money in the water sector. I think this was it happens in our business sometimes. The sector goes slow, or if you look at, except the last 2 years, the water business grew at 20, 30, 40% CAGR for most companies in the sector. So I'm not overtly worried about our payments. We've been guaranteed by all states that these money should start flowing in the next 1, 2, 3 quarters. And we are confident of that. I think structurally the sector itself is solid. As we told you last year as well, we've been focused on building capabilities of the water business outside of India. We are bidding now in a couple of geographies, and I think in the next 2 quarters, we'll be happy to give you some good news on that as well, as we take our water sector more global and not just India-centric.
Just one word with regard to these payments. I believe, a couple of governments you have outstanding from UP and Jharkhand, if I got that correct. You all have been assured that the payments start coming in from November. Is that correct? Because, I was in touch with various...
the government has always said that these payments will start coming. Obviously, they've not come at the pace that we anticipated that they would. But because they are central government projects and these monies are, central government funds, few months here and there, but we are sincerely hoping that by the end of H2 and beginning of first quarter next year, these monies should start getting normalized and the backlogs getting cleared.
Got it.
Okay, all right, Amit, we'll leave it there. Thank you very much for joining us. Good luck, good performance, and we wish you all the best of luck.
Thank you so very much.
To execute. We'll take a quick commercial break here. We're going to come back. Umesh Revankar of Shriram Finance joins in to talk about their second quarter results and, of course, the outlook going forward. Stay tuned. Coming up. Well, as promised, we have the management of Shriram Finance now joining us. Shriram Finance is the #1 volume-led gainer on the NSE right now. So it's a big name, second largest NBFC, and it continues to perform very, very well. So there you go on your screen, 5% on it, 6 million shares. So it's a big number out there, both on price gains and volumes as well. Umesh Revankar is Executive Vice Chairman at Shriram Finance. He's joining us now. Mr. Revankar, morning and congratulations on a good set. Prashant here. We're going to just highlight for our viewers what we're going to talk about. Asset quality, we want to get some guidance from you. Growth, of course, numbers going forward, and margin expansion as well. Maybe we will see more of it up ahead. Mr. Revankar, it's like it's been an up and up kind of trajectory for you now for the last almost 2 years. So it's been a one-way street. This quarter, I think what kind of stands out is that overall credit costs for you have remained very much under control, 1.78 compared to about 1.73% last quarter. When we spoke with other companies, in your peer set, some unlisted names, etc. as well, most people highlighted some stress in the commercial vehicle segment. It's not showing up for you. And CVs, by the way, is about almost 50% of your business. So I just wanted to start there in terms of what what's driven these numbers, especially on the asset quality front, and how you managed to keep it very, very steady.
Yeah, thank you. Good morning, Prashant. See, as far as our business model is concerned, we have a direct touch and access to customer all the time. And most of the customers whom we lend are individual and small SRTOs. And that's one big difference between us and many of the others. And the second thing, the asset values of the vehicles have remained very strong. It has not changed at all. That there is nowhere you will see idling of a vehicle, income getting reduced, or vehicle value coming down. So these three things are very important for viability in a CV business. And since we are in touch with the customer, we have direct access to customer, we did not see any stress as of now. Even the sales numbers, if you look at the first half in the sales numbers have gone up. The CV demand has gone up, even though most of the demand would have come in the fag end of September. But even in October, the year-on-year sales numbers have gone up. That means there is a significant demand for a commercial vehicle. The activities in the ground is quite good. And therefore, I feel the business is good and the customers are able to repay on time.
So that's the CV side of things, which you say is humming along quite nicely. I mean, growth has come across the board for you, right? Even in some of the other segments, for instance, MSME. And I think on the back of this, you are guiding for almost 17% AUM growth this year. So give us some more color on what makes you so confident that growth can be, and it's music to the ears and your investors are loving it. Stocks up 5%. So give us some more granular detail on what makes you so confident about this kind of loan growth.
See, typically the festive period or festive time is the indicator of the mood of the customers. And this time around, the October has been all-time high sales number for all the segments, whether it's a passenger vehicle, commercial vehicle, two-wheeler, and three-wheeler, tractor. Every segment has shown big growth. Only one sector that has not shown a big growth or maybe even a growth is the construction equipment, where there has been some slowdown in the infrastructure spending, which is likely to gather momentum post-rains. Normally, post-rains, these infrastructure activities continues till the arrival of rains. So this time, the monsoon has extended. Therefore, there has been little slowdown, but I think that also will join. The other point is most of the demand coming from the rural side. When I say rural, I include semi-urban also, because that is where the hinterland, rural is a hinterland for the semi-urban area. And together, that demand is quite good. So I believe the credit demand will continue to grow, with October being the peak sales or peak demand for the business.
All right. Hi, Mr. Revankar. First of all, congratulations on a very, very good showing. No worries with regard to the numbers. But sometimes the street seems to be looking ahead and sniffing something more. Now, unconfirmed reports indicate that Japan's Mitsubishi is eyeing a stake. My question to you is, can there probably be a fresh infusion to pick up 20% stake? Because that's what the unconfirmed reports are suggesting. And sometimes there's no smoke without fire, right? You want to deny totally, you want to say that could probably be something in the works. Please go ahead, sir.
See, we are in discussion with many of the banks and institutions all the time. And this time we have not even discussed this in the board. So there is no question of raising equity at any point of time.
You're definitely denying that there's no talk whatsoever with Japan's Mitsubishi to come in and take 20% stake via a fund infusion. Is that correct, sir?
First of all, we need to discuss this in the board meeting. And since it has not come to the board, I cannot further comment on that.
But sir, you are saying that you are in talks with institutions. I don't know, is that a general statement that usually you're in talks with a lot of institutions? Or are there talks ongoing right now, but it's not come to the board level? And eventually, I mean, then it could come to the board level, right?
See, generally, as you rightly said, banks and NBFCs do look for raising resources all the time. It is your raw material. And therefore, there will be multiple discussion. And unless it is becoming a very confirmed or concrete structure or a plan, then only it will come to the board.
Is there a concrete offer, Mr. Revankar, that you know of?
There's no concrete offer.
Okay, got that. So we'll
But there could probably something that we could hear in the coming month or two, right?
No comments.
Okay. I think let's just move on to the next one, Mr. Revankar, which is, of course, we've spoken about this earlier as well, a credit rating upgrade, right? What's happening there? I think we've asked you this before. When can we expect that? I mean, that perhaps a little bit more not in your control, but you have to work with rating agencies. But should we see that AAA anytime soon, sir?
We are definitely working on it. We are working with the credit rating agency. We would definitely like to improve our rating because rating upgrade and AAA gives us a lot of huge opportunity in raising resources at a lower cost, especially sovereign funds or provident funds and insurance companies' investment. Those things comes at a much cheaper rate. Therefore, we'll be working on it. Definitely, the rating agencies are very positive about it, and hopefully, we should be able to go through that or get it as early as possible.
And got that as soon as possible, and you sort of obviously effort towards that. This is not in any way related to a potential transaction, Mr. Revankar, is it? I mean, a rating upgrade and then maybe some kind of a partnership. Is there any connection at all?
There's no connection at all.
There's no connection. Got it.
Final point on the fundraising bit, Mr. Revankar. I mean, just take us through the capital ratios as of now. I mean, purely from a capital perspective, are you fully covered for growth for, say, the next 1 to 2 years? Or could there be a discussion? Because, I mean, on the growth front, you're seeing very strong growth ahead. So is there need for growth capital, or do you have enough? And then if, then the capital raising conversations are more about building a buffer for the future.
See, statutory requirement is 15%. We are above 20 now. So we have enough buffer for the kind of growth which we are witnessing, around 16-17% growth. That is sufficient for more than 2 years.
Okay.
So I don't really need capital for the growth.
For that. Got that. So if anything, it might be, something more strategic, and you will tell us more when it comes to the board level. Take that point, sir. So I just want to now, get back to the business and margins, because that's another very heartening, point when we look at Q2, because while most lenders have had some compression here and there, you managed to grow margins by about 8 basis points. So just tell us how things are moving, both on the cost of funds side and on the yield side. And I think you're saying by the time the year ends, you will be higher. The exit margin will be higher versus where you are right now. So just give us some details.
Yeah, see, the cost of fund in our books today, as it stands, it's around 8.83. We have improved from 8.89, around 6 basis points we have improved. Incrementally, we are borrowing at around 8.3 if you look at the number in the last quarter. We would like to improve it further. So as we keep repricing the existing borrowing, because 87% of my borrowing in the books is fixed, 13% is floating. The floating one will keep changing depending upon how the banks transmit. But as far as the fixed is concerned, it depends upon how it gets repriced at the time of maturity. So as we reprice it over the next 2 quarters, the cost of borrowing will come down, and that will flow into net interest margin. However, at some part of it will definitely be passed on to the customer as a goodwill gesture, and also to expand our customer base. So that will be done at the appropriate time. However, we would like to keep growing our net interest margin to around 8.5 level by the end of the financial year.
Absolutely. Mr. Revankar, just one personal change, right? So we have the current CFO is going to take over. Mr. Parag Sharma is being promoted to MD and CEO with Mr. YC Chakrabarti, who's after his term is completed this year, right? I mean, later in December.
Yeah, it is later in December. See, we have a very strong senior team, and a succession plan is I should say, well planned much in advance. And we do have a lot of other senior teams which will come into board. We will also have 2 COO coming into the business centrally, because they were managing it in the various geographies. They'll be moving to Mumbai, and this business will be managed centrally. Because we felt that the central team need to be strengthened further to know what's happening in the ground level. We also have people we had 5 geographical unit earlier. We have made it 10 now. So there will be larger...
what about Mr. Chakrabarti, sir? Will he be with the group?
He'll be with the group. He is part of a senior team. Okay. So he'll be remaining with the group.
Okay, so 2 new chief operating officers, CFO being promoted, so internal long-serving members being promoted and elevated. Thank you very much, Mr. Revankar. Great speaking with you. Really appreciate it, and good luck as you continue to execute very, very well. So that's Shriram Finance. Stocks up about 4.5% as things stand right now. 20-odd points. The market, of course, now coming up quite sharply from the lows. 25,750 is where we are at, which is at the day's highest point. Surabhi.
Okay, so that's the market for now. From finance, we are moving to food and FMCG. Patanjali Foods is the next stock on our radar. Now, it was a pretty steady quarter for Patanjali Foods as well. The profit was boosted by a 141 crore rupee tax credit. And then the weakness in edible oil margins was offset by strength in FMCG. We have with us Mr. Asthana, CEO at Patanjali Foods, joining in. Mr. Asthana, thanks very much. Good to have you in. So I'm just breaking down the numbers for our viewers. Overall, your revenue is up 21%. Your margin is pretty steady at around 5.6%. But if I break down the segments, then there is margin improvement in FMCG. I think your margin's gone from 10% to 12% over there. But there's some pressure in margins on the edible oils business. So let's take it step by step. Just walk us through what's happening, first of all, with the whole GST transition. Is all that behind us? Did that have any bearing on your, either arms of your business in Q2? And then how are you looking at growth in the second half now? First, at the headline level.
So headline level, just a quick one on the numbers first. So on edible oils, actually, we have improved from Q1. This quarter, we did nearly 3.53% of margin, EBITDA basis, which is pretty much in the ballpark range of 2 to 4% that we typically do. FMCG, we have consistently maintained that we will be upwards of 10%. We have consolidated the numbers between the HPC and the food, so it's about 12.23%. And on a net basis, also, we are pretty much about 6% plus on the EBITDA margin basis. So broadly, the numbers are pretty positive. We are very confident. Coming to the GST part of it, yes, the impact is there. We can witness it. But as I've consistently maintained, that these are food sort of products with the price points and at the level at which it is, the instant uptick is very difficult to get immediately. It will take a couple of quarters. But our estimation is that on an overall basis, by the end of this year, we should see 300 to 400 basis points of uptake on the sales part of it. So the revenue should definitely get the GST boost of that over and above the volume growth that we're targeting in foods and HPC. So that should be pretty much there.
Okay, so you're saying 300 basis points uptick at a revenue level, that would be on the FMCG side, right? So there'll be a 300 basis points GST boost when we look at the full year pictures. Just going back to margins, as you explained, now that you've consolidated home and personal care and with the FMCG, so this 12%, is that a steady state expectation that one can have? That 12% is going to be the new normal for your FMCG business?
We should get actually better than that, because this quarter, some of the overhang of the foods continued. And so those corrections are getting taken. So I think pretty much in the ballpark range of 12 to 14% is what we're targeting. And it won't happen immediately, because there is still some bit of overhang that we are witnessing post the festive season. So typically things tend to go down a bit, immediately in November and part of December. But broadly, that is the target, that between 12 and 14% on the HPC will maintain, between 2 and 4% on the veg oil side. But pretty much at the higher end of the band, if we can do that, then that will be very positive for the company.
Just to reconfirm, sir, what is the likely edible oil margins in the second half of the year? Missed that number?
So we are targeting pretty much close to 4% is what the upside target is. The markets are looking positive. That's very supportive to the overall price points. And we are reasonably confident of pretty much remaining at currently at 3.53%. The second half tends to be nearly 2/3 of the sale. So I'm quite hopeful that we should be pretty much closing closer to 4%, if not exactly 4%.
Okay, all right. And what about FMCG? By when does it become 50% of your mix? You've been guiding for that. You've been making strides in that direction. But by when does it take place?
We are making, Nigel. For example, this HPC business post the consolidation, there was a spike in the veg oil prices, because of which the percentage-wise, it is still close to 70-30. But my hope is that in 3 years' time, at a target basis, that we should be pretty much close to 50-50, both for FMCG and edible oils.
And individually, for the home and personal care business, I don't know if it makes sense now to look at individual margins, because you're talking consolidated as FMCG as a whole. But at an individual level, what are the margins of that business? What do you expect for the second half?
So the margins have been very positive on the HPC side. I think owing to some of the price point changes that we did, and some of the gains that we got on account of the purchase efficiencies. So it has been 22% plus on the home and personal care front. And
that is to be sustained?
We would like to sustain it. Margins typically, the ballpark range has been close to 18%. So this is more one-off benefit that we typically got, post the acquisition in last quarter. So I don't believe it will be as much as that. But between 18 and 20%, we are pretty confident of maintaining.
Okay. So just to revisit, like you told us on the edible oil business, you're looking at targeting 4% margin, and FMCG, the blended FMCG with HPC. What would perhaps the exit margins be, likely exit margins for the FMCG business for this year?
So this consolidation process is still on. We'd like, so currently what you're seeing, 12.2%. This we'd like inching closer to 13% plus. And because we have only half a year, for the numbers. And next year, we certainly want to cross 14% on the FMCG overall on a consolidated basis. And 4% we are targeting for the veg oils.
Okay, all right, Mr. Asthana, we appreciate you joining in. Wishing you all the best. You're sounding optimistic about the second half of the year. We'll hold you to some of these numbers. Wish you a good day ahead, and we catch up soon.
Thank you.
Well, let's welcome the next management, RR Kabel. The stock is strong in trade. They reported actually a good set of numbers. Strong growth, Good margins as well. We're now joined by Mr. Rajesh Jain, the Chief Operating Officer at RR Capital. Hi, Mr. Jain. Good morning, and congratulations on a good showing. When the markets opened up, the stock was much higher. Now, in fact, it's cooled off a little bit. That aside, if you could tell us, about the growth, because I was looking at some of your peers in the cables and wire segment, and you have actually outbeaten them. So could you tell us what worked for you? This volume growth is good. Have you gained market share? Point number one. Point number two, margins are looking good, but copper prices have moved up. So do you think you can maintain the same margins, or do they trend down a little bit from here?
Yeah, good morning, and thanks for giving me a chance to give my views. So here, if you see, our volume growth are very good and in line with our Project Rise planning, what we have done in the beginning of the year, and back with our strong initiative in terms of volume growth and margin improvement, we are on line with those plans. When we compare with industry, yes, we have done fairly good both in domestic as well as export market. And it is backed with the volume growth as well as whatever there is price rise also in good copper and aluminum prices.
Okay, so what should be the rough trajectory then, sir, from here? And market share, do you have a number? What kind of market share you had, say, a year or so ago? And since you're growing at this pace, have you gained some?
Yeah, in market share, there may be some impact, but not majorly. There will be not that much impact. But of course, since we are doing positively, so it will have a improvement in our market share. Even at year end, we are looking at good volume growth as well as margin improvement by year end.
And market volume growth is 18% for the year, right? That's what you're guiding for.
That's what we have planned.
And consolidated margins will be around 8%?
Yeah, consolidated 8%, but within wire and cable, it will be like around 8.5%.
All right. And the smaller part of your business, the FMEG business, you were guiding that it breaks even, right? Second half of the year, it moves into the green?
Yeah, by quarter end ending March 26, it will be at break even level.
Okay, Mr. Jain, morning, Prashant here. Just, so the one commodity on which there is consensus optimism, it is copper. That it is beginning a new, same kind of optimism we had about 2.5 years back. And then, of course, copper prices topped out, but we're back. We're at all-time highs. I remember speaking with cable and wire companies back then. And at that point, I remember some saying that if there is this, a big rally in underlying copper prices, demand does start to get hit. Across segments. It becomes, for a lot of end industries, it becomes not unviable, it becomes much more expensive. So I just wanted to, it's a general question, not so much about RR Kabil, but how does the business work? Because you're at all-time high copper prices, and presumably they're headed even higher.
So first, it is very hard to predict how prices will move. And but one thing, though, raw material copper is the very big raw material and an impact in our costing and as well as revenue growth also. But at the same time, see, the demand remains on the other fundamentals, how construction activities are going or how industrial growth is coming. So in short term, there may be a little bit impact, but in longer term, there will be no impact, irrespective of copper prices, how they move.
When you say short term, there may be some impact. Just you're talking in the ballpark. What can we expect? If you want to talk about your company or overall.
No, in short term, I mean to say if there is, say, a sharp movement either upside or downtime at industry level, there may be some impact. In short term, it means there may be like people take some time to settle down, but it is not like that at the industry level or even for us, there will be any major impact in demand or growth. That's what I want to say.
Okay, all right. If you could help us out, sir, with regard to the export market as well. I think exports in the past quarter, I think the shares stood at around 25%. If you could help me out with that number, and on a steady state basis, how do you see the export market shaping up? Because there's so much of uncertainty globally now.
Yeah, so export is contributing almost 27-28% in our overall business.
Yeah.
And we have seen a similar growth in my domestic as well as export market. Yeah, we have seen so much uncertainty, particularly about US market. But since US is was contributing almost 8 to 10% in my export business, but the same thing we have compensated through other markets, and we have not seen any major difference or deviation from our export planning.
Okay, so exports, you're not too worried. But what about the two big players who are coming in there? The Birla Group as well as the Adani Group, both of them have announced that they are eyeing your sweet spot, cables and wires business. Don't you think competition is going to get a little bit more fierce and that could make life difficult for a company like yours? Or do you think the market is big enough and everyone can prosper together?
First, yes, market is of course big enough, like India, and this industry is expected to grow at like in double digit, 14-15% at industry level. So of course there may be some competition, but we have to focus on our product, our strategy, and our distribution network. So we'll keep focusing on that, and we will have our own growth.
You don't fear a pricing war or something because they have the deep pockets?
No, that is, see, everyone has their own brand positioning and brand placement, distribution network. So with that, we have our own strength, and we'll work on that only.
Okay. All right. So we'll leave it on that note. Thank you very much for joining in, and good luck to you for the second half of the year. That's RR Cable at the end of Q2. All right, let's get back to the market and see what the movers and shakers are looking like. On the large cap screen, it's really, still very much about Shriram Finance. And a couple of these auto counters that are still up and about. M&M, for instance, is up 2%. Sud was earlier telling us that I think on SUVs, it's been, again, breaking previous records. One of the highest, monthly sales on SUVs. I think it's more than 30%, if I remember the number correctly. Maybe we can get Sudarshan back up. Titan is a little quiet ahead of its numbers this week, 1% lower. That's what we have for the timing. Godrej Consumer, by the way, another one that's reacting very well to numbers. Godrej Consumer is now flying 5%. And speaking of flying stocks, we all remember what Naveen Fluorine did on Friday, right? Look at Naveen this morning. What a move on Naveen Fluorine. I think all put together, it's almost 20% since the numbers came out. 5% again this morning on Naveen Fluorine.
Yeah, just a small name is Dredging Corporation. It's a PSU. It's a 2,000 crore market cap company, and it's flying away. It's done very well. 650 last week, beginning of last week. It's at about 800 and almost 900. So as I said, look at the volumes. It's not small. Some large amounts of memorandum of understanding with lots of companies, PSUs and private players. These were all public exchange notifications over the last couple of years, and there you go. That's at the bottom of the screen as well. So some MOUs worth 4,000 crores, in which dredging will participate. As we'll try and actually reach out to the company and see if they want to speak. We'll take a quick commercial break here. On the other side, Manisha Gupta will be focusing on the commodities. What's top of mind? Stay tuned. Coming up.
Welcome back. It's quiet at the headline index level. It's all about individual stocks today. So let's now turn our attention to the commodity markets and see what's happening there. Manisha, good morning. Monday, what are the cues and what's topping the attention list for you?
Well, metals clearly, and within that as well, I'm going to look at gold and copper, which has started as the next gold. I'm going to talk about both of these commodities right now. Gold first, and we are trading at around $4,000 an ounce. There was a knee-jerk reaction. We did see prices go down. Actually, for the month of October, when you look back at the month, we did see an all-time high of 4,380, and then we did see a correction all the way up to 3,925 on the lower side as well, holding around $4,000 an ounce at this point in time. Well, there has been pressure, of course, because of expectations of diminished further rate cuts, especially for the month of December, as the US Fed chair has spoken that it's not a foregone conclusion that you will see a rate cut coming in for December. So while before Powell spoke, before that, the possibility of a rate cut for the month of December was at 90%, which now stands at a 70%. So that's what's bothering the gold bulls right now. The other thing also is about the US and China trade deal. That is lent more money to risk-heavy asset classes and not so much for safe haven there. But more interestingly, what has happened over the weekend and that the markets are keeping a keen eye on is the China Finance Ministry coming out with a notification that says that all buyers, retail buyers, that is, whether it is about investment, jewelry buying, industrial gold buying as well, the tax incentive has been scrapped starting 1st of November. Now, this means that starting today itself, you will be looking at gold prices increasing for consumers in China. That also says that whatever gold is being bought from Shanghai Gold Exchange, the VAT offset that the retailers were getting, they would not be getting now. A positive that we've seen in the other regional markets come in, that perhaps Chinese consumers will start buying in from other countries. Now, this could be for India, Hong Kong, Singapore. These are the markets perhaps China would buy because of the tax, easy or lower taxes therein. So this is something to watch out for in the coming days there. The other thing also comes in from China, where the China state-backed Non-Ferrous Metal Industry Association says that you could be perhaps looking, or they have proposed actually, setting a capacity cap for various metals like copper, lead and zinc. Now, the reason that China Association is doing that is because there has been lower processing fees, and that has continued to hurt the smelter profitability in last couple of quarters, as we have seen. So much so that the association has not even put in a guidance on what the fees is going to be for the last quarter of 2025. And this is perhaps happening for the last 3 quarters now. Copper concentrate processing fees is at a record low and has been for the last couple of quarters. That is because of the scarcity of concentrate availability into market. China also has seen coal, solar, steel sectors struggle with excessive supply, low profitability and lower prices as well. So when you look at the overall prices right now, they have continued to decline. Remember, China did put a cap on production in sense of aluminum capacity at 45 million tons. This was done way back in 2017. 45 million tons has been hit in last year. So that means China would be curbing production of aluminum starting into this year. This is what we've done in sense of prices, really. So while gold and silver continue to shine, in this year we've seen prices gain up by 53% for gold. 70% is back in case of silver as well, as we see stability coming in for both of these metals. And then take a look at the base metal prices. But within that, you've seen tin outperform, and then it has been copper with 27% of gains. And positive cues continue for other metals as well, barring steel, which is in negative for this year. And then coal, of course, is down 13% for the same time.
All right, Manisha, thank you very much for that. That's commodities in focus. We'll take a quick commercial break here. Lata in conversation with the management of Bank of Baroda on their second quarter numbers. Stay tuned, coming up.
Bank of Baroda stunned with its margins increasing by 5 basis points to 2.96%, whereas the street was expecting a fall in margins because of this huge 100 basis point cut in the repo rate that the Reserve Bank did in June. The other, positive surprise is the improvement in asset quality for Bank of Baroda. As a result, the credit cost, which is the cost of providing for bad loans, has fallen sharply. Now, the worrying bit is, how does the bank prepare for the next expected credit loss regime, where you have to set provisions depending on what you expect in terms of a loss. The bank has said that their provisions will increase by about 22 to 25 basis points, which means we have to prepare for an increase in the provisioning. For all the short and medium-term questions on BOB, I'm joined by Managing Director and CEO, Mr. Devdutt Chand. Mr. Chand, good morning and thank you very much for joining us. Well, many congratulations on the NIMS. That has taken the market by a very positive surprise. Can you tell us what would have been the NIMS if you didn't get that income tax write-in? Therefore, if there is no write-in in the second half, may the NIMS fall?
Lata, good morning and thanks for inviting me. And let me tell again, we had a good quarter in terms of both top line and also bottom line. And asset quality is one of the best in many quarters. It is the lowest point now. So particularly on the margin side that you talked about, yes, this is a normalized quarter. And in the normalized quarter, what is positive is the NIA growth that the bank has given. So it's something contrary to the market in terms of giving a NIA growth. Yes, there is an impact of this income tax refund, and the gap is hardly 350 crore quarter to quarter. Every quarter we do get something. But if you adjust that also, the impact would be something around 7-8 BPS on the NIM that we have declared global. The positive, which again I say, apart from the margin that we talked about, the NI is positive. The cost of deposit is all-time low at 4.91. Last time also I said that we're going to pierce the 5% mark. And I would say that the prudent liability management and the asset management is leading to improvement in the quality in terms of asset also, at the same time protecting the margin also.
Okay, well, let me just persist for a minute. You are expecting income tax refunds in the coming quarters as well?
It is. Every quarter we do get some amount. Sometimes it is higher or lower. This quarter, it is higher than the last quarter by around 350 crore.
Yeah.
Every quarter we get something, and last quarter also we had something.
Oh, okay. So you're confident that you've seen the worst in margins? Second half will be higher than first half?
See, I said...
assuming no rate cut, I mean.
Yeah. Assuming no rate cut and everything stands as it is, I think we have seen the lowest point in terms of pricing, both on the deposit and also lending, barring the MCLR.
Okay.
At the same time, the impact of this repricing would have happened in the quarter at different point of time. So some of the asset liability, possibly the impact would not have been felt for the full quarter, which is going to be the full quarter next quarter.
Okay.
That's why I said while announcing the bank's result, the next quarter, the margin is going to be range bound.
Okay.
And as far as Q4 is concerned, definitely it would be upward bias.
Okay.
So full year basis, we said the margin would be 2.85 to 3%. That's the guidance.
Yeah, that is flashing as you speak. We have your margins. I just wanted one more word on the cost of deposits. Your bulk deposits are still 17% of your total deposits. Are you, I mean, of course, there you have said that your bulk deposits include CDs. Is there a way of reducing the non-CD bulk deposits that can improve your costing?
It is so. If you look at almost like last 2.5 years, we have been guiding that we want to reduce the dependency. Earlier, if you look at a percentage of bulk as a percentage of total deposit, it was quite high. So we wanted to reduce that because it is a volatile component and always there is a price sensitivity to it. So as on today, I mean, the impact that you are seeing on the margin, the NI, everything is because of the prudent liability management. In the current composition of the bulk and CD also, there is a higher percentage of CD, the certificate of deposit. The term is less and the pricing is also less.
Okay. No, if it is CD, it's not a worry. It is just that you'll have merged it and presented the data. I wanted to know a bit about loan growth as well. Your total advances growth is about 60,000 crores compared to a year ago. But a good 30,000 crores has come from corporate, which is a little unusual. If you see quarter to quarter, your Q1 over Q2, there is a big jump in corporate loans. Why is that? They don't normally pay well, isn't it? MSMEs and retail, the return is better, the yield is better. Which sector is this, and will not that impact margins going forward?
Let me put the context therein. Actually, our overall growth on the advances is almost 13% YY basis.
Yes.
In that, the RAM is almost growing at 16%. The retail is growing almost 17.5%. The agri also has grown at 17.2%. Similarly, the MSME almost at 14%. On a YY basis, the corporate growth is only 3%.
Yes.
Sequential basis, the corporate growth is 8%. So in terms of the growth of the bank that we are looking at on the advances, be it for Q3 and Q4, the full year again, we are keeping the guidance at the same 11 to 13%. And the RAM continue to grow stronger, maybe 15 plus, whereas the corporate full year would be something around 10 to 11%. So in that way, our incremental, what you can say, the advances would be more towards the retail asset, the MSME advances, the agri advances, as compared to corporate. But corporate, we want to do better than on a YY scale. Sequentially, it is very strong. So there are pockets we are seeing there is a good traction therein. And we typically, within the book, we look at a core corporate and the refi deal. Slightly on the refi deals, we are slightly restrictive because that's a very heavily competitive market with a lower pricing. So we are mindful of the margin, and that's why, what I say now, you can very well imagine the NIM at 2.96. That talks about our prudent management on the asset side, particularly on the corporate loan book also.
Okay. Well, it's still, it's eye-popping. Only 3% maybe when you say that, but you look at 8%, 3.7 lakh crore has become 4 lakh crore. So it is a 30,000 crore jump, which which makes you wonder, whether you'll be able to maintain margins. But let me come to asset quality. MSME numbers, of course, keep coming up. They are the highest part of your stress. Are you worried that it might increase? Can you give us some guidance, or are you MSMEs and agri loans? Any worries at all?
No, I don't think so. If you look at the fresh slippage data that we have given, that is almost 2,669 crore. It's lower than the last quarter fresh slippage and also the lower than the same quarter last year also. So that's something that we are talking about the asset quality. Inherently, the quality is really good now. At the same time, if you look at the fresh slippage, the component wise, both under retail and MSME, it is lower than that of the last quarter. Agree, there is a marginal slippage over there. So in terms of the overall book, in terms of the SMA book, we only declared the more than 5 crore acrylic SMA 1 and 2. But internally, when you look at the SMA book, this book looks quite good. So in terms of the asset quality, I don't think there is any pressure, particularly the segment of...
Not even in agri, which you admitted.
That's marginal. 100 crore for a book like us is a marginal number.
No, I agree.
That's not... No, I mean, at the same time, the denominator is also increasing, you believe. So in terms of the GNPA per se on a component of agri also would be lower than that.
Okay. Let me come to recovery from bad loans. Overall, your GNPA is like a very good picture, nothing to worry. But recovery from bad loans obviously is falling. Should we expect any positive surprise there? Because you have some 42,000 crore in various NCLT proceedings. Is there a positive surprise likely? Because all of them are written off.
See, we said earlier also our normalized the recovery out of TWO is roughly around 700 to 750 crore. And this quarter, it is slightly lower at 483 crore.
Yeah.
But going forward, we want to maintain the normalized. One-off is always contingent upon host of factors, including the processes and many things. Look, the Q2 of last year, we had a significant one-off. That's why when we compare the net profit, we say there is a YY negative. Whereas suppose I adjust that, and then the net profit is almost 22% of positive growth this year. So one-off is always, we have a good kitty, but then these are again sticky accounts. But at least one thing that I'm pretty sure that going to be, we can maintain our normalized 7 to 750 crore out of the TWO account, recovery of the TWO.
Oh, that's good to hear. Very quickly, the two major changes announced by Reserve Bank on expected credit loss provisioning. You said your provisions will increase by 22 to 25 basis points, your credit cost, sorry. Exactly what will the impact be, and for how many years will this be, this likely increase in credit cost?
Look, there is a one-time impact and there is a recurring.
What is the recurring impact, sir?
Recurring, we said the credit cost can go up by 20-25 BPS once, the ECL...
For 1 year or couple of years?
It may, we'll just look into that. It's a very provisional back of the envelope calculation as on today. One is that I said the impact, ECL impact on the CRAR is going to be 1.25. At the same time, the lower, the RWA because of the credit risk, which is again also being announced, that is going to give a positive almost 60 to 70 BPS. So net to net, it would be something around 0.75 on the CRAR, which would be again spread over 5 years' time. At the same time, the recurring would be, the credit cost can be 20-25 BPS. That's why, in spite of all this asset quality that we have announced this quarter, we kept the slippage ratio guidance and the credit cost at the same. The slippage ratio guidance is 1 to 1.25.
Okay.
Credit cost would be less than 0.75.
Okay. So that includes the ECL impact.
I mean, probable it would include that part.
Okay, got it, sir. The final question is on these ECL guidelines. The ECB guidelines. Now, foreign branches of Indian banks can also participate in acquisition financing, and banks also can participate. Of course, there are draft rules. Now, you have, a fair good network of foreign branches. So, say 1 year down the line, when both these draft rules become permanent rules, will you see more money made out of that acquisition financing?
I would not put it as a money made, but then there is a good opportunity for a bank like us to play a significant role therein. We are there in international market, and international market, this is established product. So we understand the market, we understand the product. So in that way, once it is implemented, see, we have a large book also domestically. My international book in rupee terms is almost 220,000 crore. So in that way, I think it's a very good product that need to have. As India getting into a mature market, I think we need to have this product. And once it's rolled out, I think a bank like us would be having I'll not put it as an advantage, but an opportunity for us to play a significant role there.
Okay. Yes, I guess there will also be advantages when deposits insurance becomes market-based. You may perhaps have lower costs, but those are yet shooting in the dark. We'll have a longer conversation some other time. For the moment, the market has given you a huge thumbs up. Your stock is up 4.4%. Many congratulations, Mr. Shah.
Thank you very much. Thank you, Lata. Thank you.
We wrap up on Bazaar on that note. Chartbusters coming.